you have been a voice of caution, and had we spoken yesterday around the same time, the overall texture of the market was looking rather jaded. Nifty had broken below the 20 DMA, which has been a critical support for the index, and the chatter of froth building up, the broader markets was getting mainstream attention. But there's clearly is a big shift in sentiment, since yesterday. India's GDP growth numbers that came out, of course, was a big trigger, and on top of it, the PCE numbers, the inflation numbers in the US, that came in line, and I think that of course, also has eased some nerves that were building in the global markets, and Nifty is back above 22,100. What's your sense of things? Is Nifty out of the woods again?
I'll not completely throw caution to the woods. I'll still keep some caution on the table because we haven't seen a significant correction across stocks, especially where a lot of the buying was or which was moving up one way. For example, the PSU sector is one example. We've seen some correction, but I wouldn't say it is meaningful yet to say that we have done enough in terms of reducing the near-term froth. And also look at the expiration yesterday. This was one of the largest expiries because you had the highest futures open interest on record happening at the end of this expiration, and that was sort of partly behind maybe some of the pressure that you could see. And we've seen a normal rollover, 80% of index futures getting rolled over, which is completely in line with the historical average. And people are paying around 160 points to roll over index futures, which is sort of again the top end of the range. So it all signals that there is excessive bullishness still in the market. Does that need to correct? Can be a debatable question, but I think there is room for it, and we should still keep some caution in. We've sort of priced in a lot of stuff, whether it's weakening inflation data, which is not new, it's been happening for quite some time, or whether it's the outcome of the general elections. All of that has been getting priced in. So somewhere there's room. I think there's still room for a knee-jerk reaction. There would be an election rally probably post some kind of a pullback, but one should be prepared for some kind of pullback.
All right, and March has historically been a down month for the markets. In fact, if you look at data, 3 of the last 4 Marches have been in like red months for Indian markets. And I mean, how is the setup looking this time around? Of course, there is caution, but what are some of the key triggers that you will be tracking for this series? Because we have an action-packed month, Rohit.
Yeah, so it's typically Jan, Feb, March, which is the seasonally bearish period, and Feb is usually the worst. Now, this time we've actually seen Feb do better. We've closed up 1.2% for the month, and that leaves us with watching whether March would also turn off and follow the seasonal pattern, because Feb did not. Jan slightly did. So it's open. It's an open case. It's also the year end because it's the last month of the financial year. So there is again like a seasonal case for profit booking into the year end. So that is why we'll keep those alternates open for something to happen, and probably that would provide us with better opportunities.
Good morning, Rohit. Rohit, now the personal consumption expenditures price index of the US came in yesterday, and inflation declined to 2.4%. Even the core PCE price index was at 2.8%. Not very far from the 2% that the US Fed is targeting. Do you expect the Fed cuts to happen sooner than June, now that these figures have come in?
So you see, the data is changing all the time. Just 2-3 weeks back, you had other data which was then pointing that inflation has jumped, and then bond yields also spiked, and all of that happened. After that, data has cooled off a bit. Then you're thinking about whether things will happen sooner. So I think it's basically too early to make that judgment call. We are still watching what bond yields do or the dollar does. For example, bond yields are still at 4.2%, which means they're not really indicating any downdraft immediately, not even on yesterday's data. We have not really seen bond yields drop pretty significantly. If that had happened, you could have made some sense of, okay, now markets are beginning to think of yields going down, but they're still not thinking that. So I think we're still awaiting other data points to come in month after month to get that idea. There's also, the US large borrowing program because of the debt that is consistently increasing. Remember that a lot of the growth that we are seeing in India and the US has been driven by government spending. And somewhere that can also trickle into some degree of inflation. So that is the risk that, bond yields, while we want them to go down, because you have a large borrowing program, it's not going to be an easy course unless you're really going to go back to bond buying all over again. So we are still in QT mode. We are still not gone back to QE. And as long as that is true, expecting bond yields to decline very, very fast is I think, overdone right now. The risk really is that bond yields start rising further. They've already picked up from, they'd gone down to 3.8. Now they're stuck at around 4.2. What we are watching out for is, do they stay here? Do they hedge higher? Can we actually go towards 4.5, 4.6? And that would then again get, perceived as a risk in markets.
So there's another curious case of China from the global. The economy is slowing down, but money seems to be pouring in, and China state-backed funds have poured in more than 410 billion yuan, almost $57 billion, into onshore shares in a bid to prop up the markets. Now, why do you think money is flowing into the Chinese markets while all indications, whether it is their real estate or their manufacturing, are indicating towards slowing down? What is this conundrum? Can you explain it for our viewers?
And are there any green shoots of recovery that the investors are perhaps banking on? Because of course China is available at a significant discount. In fact, half of what Indian markets are trading at. We are trading at a PE of about 20 times earnings, whereas they are available at about 9 PE of 9. Rohit.
Yes, so you've sort of hit it on the head. Valuations become one of the primary reasons why you buy a market at the beginning, and so China is in the value zone. So that is the first reason why it will attract money, is that a lot of value investors will step in and want to buy at these low prices. And you never get stocks at low prices on good news. I mean, you cannot say that Chinese economy has turned around and you'll get it at eight times earnings. It doesn't work that way. Just like the Indian market today, you're just getting the best GDP data and you're close to all-time highs. It was not possible that if you got 4.8% GDP data and you'll be at all-time highs. So good news is always at the top, bad news is always at the bottom. And that is how you have to use information in your favor. And I think that's what the value buying is. But remember that there was also a stimulus by China a year ago or 2 years ago. Their markets did rally and then they gave up on that. So one, there is a short-term trigger. Okay, fine, they're stimulating. There's a case for value buying. Is it sustainable over a period is a completely separate question. But it does create a short-term trading opportunity, from a couple of months perspective, where Chinese stocks can do well because they've fallen too much.